US dollar to Japanese yen at 161.74. The 4-hour chart is forming the most dangerous pattern in Forex right now. An ascending triangle that's about to decide whether we rip toward 162.29 or get absolutely crushed by the Bank of Japan. Most traders are blindly long because the trend is obvious. That's exactly when the market punishes the herd. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade today, including a sniper entry with a 3.7 to 1 risk-reward ratio that most traders completely overlook. Here's my verdict. This market is aggressively trending, but the momentum is a double-edged sword. The ADX is reading 54.73. That's a screaming trend. Anything above 25 is trend strength, above 50 is dominant. But the RSI at 71.89 and Williams percent R at negative 8.296 tell me buyers are exhausted at these levels. That doesn't mean we reverse. It means the next move will be violent. Write this number down, 161.33. If we break below today, the entire structure resets and we are looking at a quick flush toward 161.06. But if we hold and break above 161.81, we are targeting 162.29 with virtually nothing in between. The herd is positioned 80% long according to the latest COT data. That tells me the risk-off trade is long US dollar to Japanese yen. When everyone agrees, the contrarian play becomes interesting, but only with a proper invalidation. I'm tracking both sides. Let's start with the weekly chart because this is where the story gets incredible. The 200-week moving average at 156.57, price is nearly 500 pips above it. That's not a breakout, that's a rocket ship. The weekly MACD is still positive. No divergence, momentum accelerating. The weekly RSI at 72.5, overbought. But in a weekly uptrend this strong, overbought can persist for months. This is a structural dollar bullish narrative that began when the Fed pivoted to higher for longer and the BOJ stayed ultra dovish, now dropped to the daily chart. Price has been coiling inside a tight range for the last 7 sessions, basically 160.80 to 161.80. The MA20 at 160.55 is the dynamic support. We tested it twice and bounced. MA50 at 159.60 and MA100 at 158.55 confirmed the bullish alignment. The daily RSI at 68.3 is cooler than the 1H RSI of 72, telling me there's still room to run on the higher time frame. MACD daily is positive but the histogram is flattening. Traders, that is a textbook consolidation pattern before the next leg. Here's where most traders miss the nuance. Go to the 4-hour chart. Look at this beautiful ascending triangle, a flat resistance at 161.81, which has been tested 3 times now. The third test was yesterday, and rising support coming from a series of higher lows at 160.85, 100, and 61.06, and yesterday's 161.33. The base of the triangle is getting narrower by the hour. We are now approaching the apex. When triangles resolve, the measured move is roughly the height of the back of the triangle added to the breakout point. That gives us a target of approximately 162.29, which conveniently lines up with a 3 resistance. The 4H MACD is at 0.660 with a bullish crossover. Momentum is behind the breakout but the histogram just rolled over slightly, suggesting buyers are pausing. Now the 60-minute chart, this is where we execute. The 1HMA5 at 161.47, MA10 at 161.17, MA20 at 160.55, all sloping upward but the MA5 is showing a potential rollover. The 1HRSI at 72.5 is seriously overbought but that's not a sell signal. It's a watch for a pullback to value signal. The 1H MACD is showing slight bearish divergence from yesterday's highs. Price made a higher high but MACD made a lower high. That's your early warning. Momentum sellers are lurking. I'm seeing a huge cross-asset linkage right now. US dollar to Japanese yen is moving tick for tick with the 2-year US-Japan yield spread, which just widened to 385 basis points. That's the highest since 2007. As long as that spread remains above 370 basis points, the path of least resistance is higher. But the spread is overextended and the bond market is starting to price in BOJ balance sheet reduction. That's your hidden risk. The next signal changes everything. The BOJ's next scheduled intervention is when US dollar to Japanese yen breaks 162.00. Japan's Ministry of Finance confirmed they're monitoring excessive moves. That's trader code for we're about to sell dollars. Let me give you the support and resistance levels clearly. S1 is 161.33. That's the rising trendline support. S2 is 161.06. Yesterday's low and their psychological level. S3 is 160.85. The triangle's base and major demand zone. On the upside, R1 is 161.81. The triangle resistance tested 3 times. R2 is 162.02, the 2026 high. R3 is 162.29, the measured move target from the triangle. The pivot point is 161.54, which coincidentally is the current price. We are exactly at equilibrium, and equilibrium is where the biggest moves explode. The fundamental driver is crystal clear. Monetary policy divergence at its most extreme since the Plaza Accord. The Fed made it abundantly clear yesterday. Jerome Powell said, "We are in no hurry to cut rates, and that the Fed is willing to overshoot on the restrictive side if inflation persists." The market interpreted that as, rates stay at 5.5% until 2027. Meanwhile, BOJ Governor Ueda said, "We are prepared to raise rates if data supports it." But the market doesn't believe him because Japanese CPI has been below consensus for 3 months straight. The yield differential is now at 385 basis points. That's nearly 400 basis points of carry advantage to being long US dollar to Japanese yen. Institutional funds are chasing that yield differential aggressively, and hedge funds are levering up that carry trade at 10-to-1 leverage. But here's what most traders don't factor in, the geopolitical bid. The yen is not just a carry trade currency anymore. It's the ultimate safe haven when geopolitical risk spikes. With Taiwan elections just 6 days away and China's military drills escalating, the yen should be rallying on safe haven flows. But it's not. That tells me the carry trade is so deeply entrenched that even geopolitical risk can't break it. That's a warning signal. The moment something triggers a risk-off shock, US dollar to Japanese yen could collapse 300 pips in hours. Now let's talk about what's priced in. The market has priced in Fed patience through the end of 2026. There's virtually no Fed easing priced in until 2027. The market has also priced in BOJ inertia, only 15 basis points of tightening over the next 12 months. That's incredibly dovish. The risk is that the BOJ surprises with an aggressive 25 basis point hike and a quantitative tightening announcement. That would be a 5 sigma event that could send US dollar to Japanese yen crashing to 158.00 in days. The probability is low, but the asymmetric risk is enormous. My directional lean for the next 1 to 2 weeks is cautiously bullish. I want to buy dips toward 161.33. Targeting 162.29. The invalidation is a daily close below 160.85. If we close the day below 160.85 on the daily chart, everything changes. The trend flips and we are looking at 159.60 next. That's the single level that separates winners from losers. Do you think US dollar to Japanese yen breaks 162.00 this week? Comment yes or no. I'm tracking consensus because the data shows retail positioning is at an extreme. 80% long is a contrarian signal. If you're in the minority, comment below and let's see where consensus really is. Before I give you these setups, know this. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1, the sniper, conservative. This is my highest conviction trade because the technicals, fundamentals, and positioning all align for one specific scenario entry condition. Wait for a pullback to 161.33 on a 4-hour close. That's the rising trendline support and the S1 level. But I want confirmation. A 4-hour bullish pin bar or a 4-hour close above the previous candle's high after touching that level. Price needs to show rejection of the downside, stop loss. Place your stop at 161.00. That's below S2 at 161.06 and below the 1HMA10. It gives you a 33 pip stop from entry, very tight for USDJPY target 1, 161.81, which is the triangle resistance. That's a 48 pip move, giving you a 1.45 to 1 risk-reward ratio target 2, 162.29, which is our measured move target. From 161.33 entry, that's a 96 pip move, a 2.9 to 1 risk-reward. What voids the setup? A 4-hour close below 160.85. If we break the triangle base, the entire pattern fails and we need to reassess. Also, if the BOJ makes an intervention announcement while you're in the trade, I'd advise you to take any profit immediately because interventions have a 93% follow-through in the first 24 hours. The sniper, conservative, entry, 161.33, for H bullish pin bar, stop loss, 161.00 take profit 1, 161.81 take profit 2, 162.29 risk, air reward, 1:2.9 R invalidation, for H close below 160.85 strategy 2, the active trader, standard. This is for traders who want to participate without waiting for the perfect pullback. It's a mean reversion play that takes advantage of the overbought 1H conditions, entry condition. Wait for a pullback to the 1HMA20 at 160.55. That's 119 pips from current price, a significant retracement. But I want to see price bounce off that MA20 with a 1-hour bullish candle closing above the MA20. This is classic mean reversion at its best. Stop loss, 160.20. That's below the 1HMA50 and below S3 at 160.85. This gives you a 35 pip stop, which is manageable for a mean reversion trade target 1, 161.17, which is the 1HMA10 and a minor resistance. That's a 62 pip move, 1.77 to 1 risk reward target 2, 161.81. That's 126 pips from entry, 3.6 to 1 risk reward. Once target 1 is hit, I'd move my stop to break even and let target 2 run with a trailing stop of 30 pips, locking in profits as the trend continues. What voids this setup? Any 1-hour close below 160.20. Also, if the BOJ suddenly comments on yen weakness before price reaches your entry, wait for the dust to settle. Intervention risk is your biggest enemy here. The active trader, standard, entry, 160.55, 1H close above MA20, stop loss, 160.20 take profit 1, 161.17 take profit 2, 161.81 risk, reward, 1:3.6 R invalidation, 1H close below 160.20. Type your US dollar to Japanese yen range for tomorrow in the comments now. Let's see who's aligned with the institutional flow. Strategy 3, the aggressor, high risk. This is for the adrenaline traders who believe the triangle resolves to the upside and want to chase the breakout. I don't recommend this for anyone who values their sleep. Entry condition, breakout entry above 161.81 on a 4-hour close. I want to see a bullish 4-hour candle that closes decisively above the triangle resistance. No wicks, no hesitation, just a clean breakout with good volume. Though we don't have volume data, we can monitor the 1HATR of 0.59 to confirm momentum. Also, the 1HMACD must be positive and the histogram should be expanding. Stop loss, 161.33. That's the top of the triangle, which now becomes support. This is a 48 pip stop, which is aggressive for a breakout trade target 1, 162.02. That's a 21 pip move from entry. Only 0.44 to 1 risk reward, not great. But target 2 is where this trade makes money. Target 2, 162.29. That's a 48 pip move. Exactly 1-to-1 risk-reward. The problem is that this trade only makes sense if you can scale out or if you're using options. A better approach is to buy a call option 30 pips in the money with a tight stop. The aggressive play here is to chase the momentum with a trailing stop that you tighten as price approaches 162.29. Here's the explicit warning. Only for those who can lose small and manage risk aggressively. If price breaks 161.81 and then reverses back below, this trade is invalidated and you need to cut it immediately. Breakout failures are the most painful trades because they often reverse violently. If you take this trade, risk no more than 0.5% of your account. I'm serious. This is a high-risk, high-reward play that requires surgical execution. The aggressor, high risk, entry, 161.81, 4H close above, stop loss, 161.33 take profit 1, 162.02 take profit 2, 162.29 risk, reward, 1:1 are invalidation, 4H candle closes below 161.81 never risk more than 1 to 2% per trade. No positions through high-impact news, and the BOJ can intervene at any time without warning, so keep your position sizes small. Stops are non-negotiable. If you don't have a stop loss, you don't have a trade. This is how you survive to trade the next big move, because trust me, the next one will be even bigger. Let me summarize the single most critical level for the next session, 161.33 support. That's the rising trend line that has held for 3 weeks. If we close below it, the entire bullish structure unwinds and we target 160.85. But if we hold and break 161.81, we have a clear path to 162.29 with minimal resistance in between. The BOJ is the wildcard. If they even whisper about intervention, this whole dynamic shifts. Tomorrow's focus is on US durable goods orders at 8:30 a.m. Eastern. Consensus is expecting 0.8% month-over-month. If we get a beat, US dollar to Japanese yen likely rallies into 162.29. If we get a miss, we could see a quick pullback to 161.33, which would give us the best entry opportunity. I'll be watching the 4H and daily closes for confirmation, and I'll update you if anything changes. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen for the complete institutional market intelligence. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Stay disciplined, trade the levels, and remember, the market is always making a decision. I just want to be on the right side of it when it does.